Is the biggest IPO in Wall Street history actually a Trojan horse for a $3.4 trillion mega merger? Broadcom just missed, and it's dragging the entire chip sector down with it. Shares plunged 15% in pre-market trading after the company's revenue forecast failed to meet Wall Street's sky-high expectations. Now, you're probably thinking, one company missed earnings. Why should I care? Here's why. This isn't just a Broadcom story. CNBC reported that Micron fell 7%, Marvell dropped 7.5%, AMD slid over 4%, and Intel lost 4% before the bell even rang. Futures tied to the Nasdaq fell 1.4%. S&P 500 futures dropped 0.7%. What traders are calling the AI expectations trap is now fully in play. For months, chip stocks rallied on the promise that artificial intelligence spending would keep accelerating forever. Turns out, very good growth isn't enough when the market has priced in extraordinary. HSBC analysts flagged sliding chip prices and a slowdown in AI spending rollout as among their biggest worries. For anyone holding a tech-heavy index fund, this morning matters. The Nasdaq's recent rally was built on semiconductors. If chip earnings can't meet these inflated expectations, the entire AI trade gets repriced. And the pain doesn't stop in Silicon Valley. Across the Pacific, SoftBank just lost 11% of its value in a single session. The Japanese tech giant, which recently overtook Toyota as Japan's most valuable company, got caught in the same undertow. But here's what makes SoftBank's drop different. This isn't just contagion from Broadcom. SoftBank's stock had already surged 70% year-to-date on a single thesis. That CEO Masayoshi Son's massive AI bets would pay off. Son himself told CNBC he expects the AI revolution to be 50 times larger than the dot-com boom. 50 times. That's the kind of conviction that either makes you a visionary or gives you the longest fall. When we covered reports of SoftBank's significant pledge to build Europe's largest AI facility, we flagged the execution risk. Today, the market is pricing that risk in. Samsung and SK Hynix also fell in South Korea, pulling Asian tech indexes lower. Deutsche Bank analysts warned that markets have become fixated on short-term momentum, unable to map long-term AI trajectories with realistic assumptions. So what does this mean for your portfolio? If you own international tech, ETFs, or broad emerging market funds, today's Asian sell-off is a reminder that AI concentration risk isn't just an American problem, it's global. And yet, the biggest story today isn't about what's falling, it's about what's launching. SpaceX just filed for the largest IPO in Wall Street history. The Financial Times reports the company is pitching investors a valuation of $1.78 trillion, seeking to raise up to $86 billion. Those numbers are staggering on their own. But buried in an amended S1 filing, Fortune spotted something that stopped Wall Street cold. A single news sentence opens the door for SpaceX to merge with another entity after going public. According to early reports that have yet to be fully confirmed, a SpaceX-Tesla combination could create a $3.4 trillion behemoth. Today's filing adds fuel to that speculation. There's also a friends and family provision. 5% of IPO shares, roughly $3.75 billion worth, are reserved for insiders, executives' families, and business associates with no lockup restriction. They can sell immediately. That's an overnight windfall most retail investors will never access. Here's what actually matters for your account. If SpaceX goes public as planned, every major index fund will eventually have to decide whether to include it. A company this size reshapes index weightings the moment it enters. And if a Tesla merger follows, the portfolio implications multiply. Volatility creates opportunity. Subscribe to stay informed. This has been The Financial Brief.